Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. Lots has happened in the last 72 hours, if you will. Jackson Hole, China trading, cutting its trading tax, Asian market starting off okay. The US market's actually doing okay overnight too. But the conversation with our guest today on Talking Point is Taher Badshah, is not necessarily just about what's happening in the short term, though the short term events might have an influencing factor on what could happen over the medium term. It's a pleasure for me to welcome him on the show. Taher, great having you. Thanks for taking the time out.
Thank you very much. Happy to
So,
be here.
Taher, how do you look at the nuts and bolts and the pulls and pressures around markets currently? Because the globe seems to be in a bit of a dizzy around growth, or a bit of a skittish growth environment. We are doing well, but most people say that we are priced nearly to perfection. How do you look at the scenario then?
Yeah, across all kinds of market conditions, in which we will always have situations where there will be a deviation from the script, and you typically, when you're trying to design a script in your mind in terms of what is likely to be or the way the markets are expected to behave over a, let's say, 12, 18 month period, if not more. Uh, uh, you do take into consideration the fact that there might be some deviations from the story that you have in your mind, and you factor in for that. So I think some of the developments which have happened over the last some time, particularly with regard to certain domestic issues which cropped up, primarily inflation, and the trajectory that we've seen as far as the monsoon is concerned, is something that we budgeted for. I mean, we obviously could not project monsoons to the T, and we could not obviously you know fix or anchor ourselves to the fact that it will be a good monsoon or a bad monsoon. But by and large, I think from the point of view of the market, we took that into consideration, and in general, our view, at least over the last 2-3 months, has been that we are getting into a phase where India can probably deliver a reasonably decent and robust economic growth cycle compared to what it has seen in the prior for 5 years. And I think we are holding on to that view even as of now, despite some of these new angles which have developed in the market today. We think that the investment cycle has been strong and probably has legs to continue to maintain strength. So 40% of the economy by and large is taken care of. The 60%, which is basically the consumption part, is something that we've begun assuming that this is, while it is weak or probably has mixed trends, but it probably has the ability to strengthen as we get into 2024, if not 2023. And I think we're still holding on to that view, despite the fact that monsoons have not typically moved up or have not come up to expectations. So I think, in general, I think we are holding on to a reasonably positive view about the markets. While you mentioned about the fact that um, there are pockets of the market which are a little concerned about valuations, and I agree with you that there are certain pockets which are somewhat overextended, and now we need to kind of tread carefully in some of those pockets. But there is a fair bit of possibility of some of these pockets also showing up earning surprises. So what we are looking at as valuations today may not necessarily be the apparent valuations, and the real valuations could be somewhat different. Yes, but we obviously have to avoid some of those pitfalls. But I think the markets are getting broader. You're finding opportunities in places where you're not necessarily countering the same valuation challenge, or you have growth which is a lot more supportive, or you have some structural trends that you want to probably bet on, and therefore take a somewhat longer handle of things compared to what is reflected in very near term or 12-month earnings.
Interesting. Taher, the 60% of the economy, which is consumption, and I heard you say that at least in 2024 you are constructive, but I was just thinking, are we entering into a possible favorable phase with the festive season around the corner, the World Cup, G20 related travel arrangements, so on and so forth? And as I was listening to one con call in quarter 1, maybe a 30 to 40% higher wedding dates in this year relative to the base as well. So are we entering a bit of a favorable phase for consumption as well, or not necessarily so?
So yes, you're right, and we have an eye on that. Not necessarily that we are factoring in all these events which are lined up over the next 2 or 3 quarters. But I think where it does provide obviously support to at least the urban part of consumption, and which has held up quite okay under the circumstances, and given the fact that we've had 250 odd basis points of interest rate hikes over the last 12 odd months. But I think we are also hoping that as inflation probably eases as we get into 24, and interest rates also, to our mind, as of now, look like the, on balance of probabilities, it looks like the interest rate heading up from here. If those two things, I think, materialize, if not in 23, then in 24, it's quite likely that it might even perk up rural consumption, because that's a lot more sensitive to inflation and interest rates. Uh, so then, that's basically our expectation, that you have drivers along the way, at least, which can hold up urban consumption, tier one, tier two consumption, high end premiumization consumption. But it can also probably bring back value consumption at the lower end of the market in 24. So then that's basically the reason why we think that the markets can broaden, and then the 60% of the economy also can start contributing a little more meaningfully than it is doing today.
Got it. The other aspect that you mentioned about how some stories or some businesses or some stocks are priced high, but the earnings surprise possibility is high there too. Taher, please tell me, how do you kind of differentiate between a good story that is price punchy uh, versus a okay story but has the valuation comfort? Because a lot of these stocks which have run up, the stories around them, the book to bill ratios in certain cases of manufacturing or order booking coming in is very, very strong. So how do you kind of choose between the two?
Yeah, so I think in this regard, Neeraj, we basically fall back upon our investment framework, and which allows us to, attach an investment rationale and categorization to every name that we have. And there are some of these which one mentioned, which are punchy on valuations, but basically reasonably strong in terms of their qualitative uh, uh, positioning, and some of their competitive advantages. In that, we are obviously in that particular category, we are willing to give a lot more leeway as far as valuations are concerned. Um, uh, and these divisions or categorization help us in order to differentiate some of these names or square them off one versus the other. So I think in that regard, it is we have a defined universe, but then it is subjective to the manager of the particular stock and how he wants to play it in his particular portfolio. It is available to him to be able to kind of play the story, probably even take um, the drawback of somewhat higher valuations in the near term. But then probably some of these stocks also provide you a backbone and support to the portfolio at various points in time in the market cycle. So I think that is left to the individual manager's approach. We essentially follow a system where we allow that liberty and flexibility, so long as most of the qualitative checks on the business and the long-term growth trends are reasonably clear to us. Then the valuation is more in the minds of the respective investor or the fund manager who runs that particular strategy.
Got it. Okay. Then some specifics, if you will. So we, of late, I've seen a bunch of notes coming out talking about how some of the private sector banks are getting have been punished quite a bit or have not moved as well, and maybe there's a case for investing out there. So and the high quality banks have necessarily not necessarily moved. In fact. There was a note which I read which spoke about how the public sector banks since November 2020 probably have fared much better than the private sector banks do. My question is there a reason for that to happen? And do you believe that there might be a case for considering some of the large private sector banks as investment candidates?
So we already have a fair bit of exposure to some of these private sector banks, and for have been having it for a good amount of time. It's another issue that they've not necessarily contributed as much to the portfolio's performance over the last some time. But there are many of them are actually turning value. So again, falling back onto our investment framework, we have a good division between, as I said, different types of stocks, and there is a good demarcation between growth and value names. Some of these are actually getting into that value bucket, and since you know that we run an important value strategy as well, many of these stocks are actually quite pertinent from the point of view of playing some of those value opportunities that are there. So I think they are in that bucket. Yes, you're right that public sectors of PSUs have done, banks particularly have done. PSU banks have done much better than the private sector banks over the last some time, and I think the key reason probably has been that, in my view, is apart from technicals, which are essentially about ownership, etc., is more about the fact that we were in a rising interest rate cycle, and in that phase, typically the public sector banks are at an advantage. I think, as I mentioned earlier, that on the balance of probabilities, we are probably looking at a turn in the cycle, if not at 23 on 24, as far as interest rates are concerned. And if that were to probably materialize, then I think at least the relative attraction of private sector banks goes up. It may not necessarily do any damage to the public sectors, but at least it enhances the attractiveness of some of the private sector banks, and especially given that they have been underperforming. And we know there's in the market cycle, many of these underperforming stocks, they have a tendency to come back. We saw that exactly the same thing happened 2 years ago in industrials. We took a fairly overweight bet, even though the investment cycle was not very clear at that point in time. But given the fact that they turned value, and there was no interest in industrials at the beginning of the post-COVID rally. But here they are. We've seen what the kind of expansion that we've seen in multiples. I think it's quite a fair possibility. Although I'm not at this stage inclined to take a bet that we will see significant, or rather, a possibility that private sector banks will go back to those all-time highs in their valuations. I think in general, the private sector will probably find it difficult to cross their previous peaks as far as their valuations are concerned. And to that extent, we don't have a choice but to, as of now, temper our expectations and play for their earnings growth. Unless they become too undervalued, then we play for that some bit of that re-rating possibility, but not for the fact that they will be trading at valuations which are significantly above their previous peaks.
Got it. Well, but mean reversion at some point of time. Okay, interesting. Are IT companies providing value? And connected to that question is also this whole change around the internet companies as well. This whole conversation around Zomato now looking to becoming closer to break even. Paytm has shown direction. Some of the other companies are doing that as well. I'm not asking you for specific stock comments, but just using this as illustration. So two-part question, one on IT services, whether they provide value to you currently, and two, your view on the internet companies.
Yeah, so I mean, the best testimony of our view on the IT services providing value is the fact that in our value strategy today, we are nearly about 600 basis points overweight as far as IT is concerned. So that's something which is reflective of that. So many of these are falling into the value bucket. I think we played this cycle in technology, IT services sometime back in 2018 as well, when sector was bereft of growth, and valuations had collapsed for one reason or the other. Some were even trading below Nifty. I remember some of the large caps at that point in time, and then we once again bought them in our value strategy. We went overweight, and eventually it was COVID, which turned out to be a trigger which we never knew, but obviously. But in 21, we saw valuations go from one end to the other, and we made our money in that process. So I think that is where we find them. They're not necessarily as cheap as they were in 2018. But once again, as you said, the mean reversion cycle, something that we expect here as well. And when you're playing value, you are a lot more conscious about balance sheets and the quality of balance sheets. And it's nice to therefore be able to play a sector like IT services as value, because obviously we don't have any challenge as far as the balance sheets are concerned. And perhaps even corporate governance or any other issue for that matter, they are very high in terms of dividend payouts or buybacks and cash distribution in general and so on. So I don't need to get into that. But so it gives you that additional confidence. That's one. So we are considering clearly IT is a value play, and therefore you will not find as much overweight representation in some of our growth strategies. But clearly the value strategy has taken a stance that this is one of the places which is, and it's classic sectoral, pessimism that you generally in a value strategy, you typically look for pockets which are not doing well, which are where markets are indifferent, when no interest, and so on and so forth, those kind of typical characteristics, and then wait for the pessimism to convert into optimism over a period of time.
Could there be
Your
catalysts?
question
Sorry,
on
just before you move to internet, sorry, Taher, but could there be catalysts which could turn the pessimism into optimism in the near term? Is there something on the horizon that the market may not be seeing, but you are seeing?
no, so it's not that I don't think we are seeing something which the market is necessarily not seeing, but I think there are parts which the markets are seeing, but not probably willing to trust in, believe in, be comforted with, and needs more evidence. So, for example, even large deal signings which have happened in a somewhat tough environment of the last 2-3 quarters, probably the fact that wage inflation is not going to be of the same order or magnitude as what we saw in the last year, and the possibility that, and also the fact that S&P 500 in general, I mean, the companies in S&P 500 are not necessarily doing as badly. There are IT allocations which are maybe being moderated, but not of the type which completely disrupts the longer term story or even the medium term story for that matter. So I think we are taking a view that 24, if not 23, should be a year when we can see some comeback and a trend stabilize. There is some evidence, but as of now, the market is willing to probably gloss over it.
Okay, and sorry, just the last follow-up piece on internet stocks.
Yeah. So on internet stocks here, I think we, in general, we maintain this template all along ever since we've seen some of these new listings over the last 24 odd months. Is that we've generally been of the belief that there will be some of these companies which will make it large and make it big and will become relevant. And so 2-3 things that we look at. One is that what is the competitive differential versus the next best player, and can they keep increasing the gap or at least maintain that gap? The second is that we generally did not want profitability to be too distant out in time. We understand that these are businesses which require investments and therefore may not necessarily be profitable from the word go. But we also did not want to be into companies where we felt that the eventual profitability path is too much out in time. That makes it a little more difficult, at least from the point of investing public money. And the last thing is obviously everything around management and their capabilities. So I think on the first 2 scores, we have seen a couple of companies move in the right direction. There are some which have not moved in the right direction as well. So and to that extent, where we've seen that competitive advantages have either been retained or enhanced, or the margin or the differential with the next best has increased. And the second is that if at all they've come closer to the profitability, and you mentioned some of these, and we've seen some of these deliver better in terms of that aspect. I think we have been willing to participate, and we have bitten into some of those more recently. Some even in our value strategy as well. I would say so. So that's how we are approaching this space.
Got it, Taher. Would have loved to chat more, but I understand you've taken enough of your time, so we'll let you go on that note. Thank you so much for taking the time out today.
Obviously, in person.
And look forward to having more.
Certainly. Take care.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.